Today is going to be a very important video because as you can see, we are covering rejection blocks, but not only just rejection blocks, we're going to go over the entire strategy that I use to trade every single day in the markets. And yes, I have payouts to back this strategy up as well. So let's go ahead and jump straight into the teaching. But first, make sure you drop a like to help support the channel, but let's go straight into it. So what even makes a valid rejection block? Okay. Number one, it has to sweep liquidity, which could be equal highs, could be equal lows, previous week high, previous week low, like any form of liquidity, it has to sweep, okay? Or if it doesn't do that, it has to strongly reject a PD array. So that could be a fair value gap, an order block, a key open, a fib level, another rejection block in theory, literally any PD array that you understand. If there's a candle that rejects it, then it's a rejection block, okay? Or it has to sweep liquidity. And then if it does both of these, it's a very, 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 very high confluence trade, okay? It's a very good rejection block if it sweeps liquidity and sweeps into a PD array or taps into a PD array and rejects it, okay? Now, number three, you want to only be taking rejection blocks that are not trading against the draw on liquidity. So if you're bearish, you don't want to take a bullish rejection block, obviously, right? So you need to have a draw on liquidity, and you want that rejection block to be in alignment with that. You don't want to be trading against it. Number four, engineered liquidity near the CE makes it higher probability. Now, what does that mean? Okay, engineered liquidity is whenever you have price that comes, okay, let's say we have a bullish rejection block, and you find the CE of it. What's the CE? The midpoint, the 0.5 level of the rejection block. So we have a bullish rejection block, price comes down and front runs the midpoint of the rejection block, okay? That is engineered liquidity because now, whenever price comes back down and sweeps out that level and taps the CE, we have two things happening right there. Number one, we're tapping the most sensitive part of the rejection block, and number two, we're sweeping out a form of liquidity. So engineering liquidity near a rejection block, in particular the midpoint, makes it higher probability, okay? And then lastly, if we have an SMT between the two indices, right? So NQ and ES. So if, ES sweeps the high and NQ does not, but there's a rejection block there, that is even better because it makes it a protected high or a protected low with the SMT, okay? Now, some of the best time frames to look for these are going to be on the daily, the 4 hour, the 1 hour, 15, and 5 minute, okay? These are the key time frames we're going to be using. You can also use the 1 minute. I mean, any time frame works, but the best ones for using the midpoint is going to be the 4 hour, 1 hour, 15, and 5. But honestly, don't pay too much attention to this here. We're using it in all time frames. You don't want to be locked into 1, 2, 3 time frames. You want to be cycling through them all. So these are just kind of to help you here, but you don't have to be dead set on these time frames, okay? But remember, when you're trading these rejection blocks, okay, the best trade is almost always the scariest trade, okay? A lot of traders close early when price moves against them at this entry. You want to do the opposite. So what that means is a lot of traders either A, get scared so they don't take the trade, or B, they also close the trade too early once price starts going in the direction. You cannot do any of that, okay? These trades are scary. We have very small, tight stop losses, and honestly, the win rate isn't the highest. So you're going to take losses, and you have to understand that, okay? Moving forward, I have just a couple examples of recent trades that I've taken. This was a rejection block entry, played out perfect. It looks like a top tick. It's not, we're trading off the rejection block, so it's not necessarily a top tick, but this is still really good RR. Here's another one that I took paired with the 10 a.m. key open, which we will do very often. You can see, boom, high risk to reward, played out perfect. Here's another one as well. It's a little bit harder to see, but we got a rejection block in here, entry here, boom, straight to TP. And you can already see we got the SMT up here, rejection block reacting out of a gap over here, boom. We had everything we needed and executed cleanly. Here's another trade example right here, key open, rejection block on the key open, fib level coming out of this gap here, bang. Now I'm sure most of you guys know this is pretty much Powell's model. Okay, Powell's the one who popularized rejection blocks, and he has like a couple different models, right? The 10 a.m. key open, and then also just rejection blocks. And so I'm gonna be talking about both of those because I trade both of them. But overall, you're thinking about it the same. You're not really thinking, 10 a.m. trade, rejection block trade. It's all paired together, right? you're just using ICT concepts and your entry model is rejection blocks. And you're pairing that with key opens, which is again part of ICT. So if you understand ICT, then this is going to be super good and crucial for you. It's going to add framework for you to execute these trades. If you've never traded ICT, that's totally fine. You're just going to have a lot of learning to do. Okay. So this thing that I have here, I'll leave it somewhere for you guys to grab as well. But it's very good. Okay. It has checklist, full notes, quick reference, risk rules, all sorts of stuff built in, and it explains everything very well here. I'm going to go through these one by one and explain them to you so you can understand, and then you guys can also grab this document and be able to look at it yourself and use it each day while you're trading. So basically, top-down analysis, here's where it starts out, okay? The Powell model, or the model that we're trading, what you do first is you set your daily bias. Now, how do we do that? PXL, PXH, okay? Let me show you really quick how we look at that. So on the chart here, let's start back here at this, we'll just start somewhere, okay? But basically, so this candle here closed above the previous day high right here. So we expect this candle, after we're done, we expect the previous day high to be taken, okay? Now this candle closes above this candle here, so we expect the previous day high to be taken, which it does, okay? Now we sweep out the high and we close down inside of the candle. So now we expect the low to be taken, okay? So now for this, this candle here sweeps out the low, closes back inside. So we expect, actually, no, it didn't. It swept out the low, but we still closed down here. So since we closed below this candle's low here, we expected this low to be taken. Now, you can see it didn't happen, but the reason it didn't is because we had this fair value gap. So sometimes you just have to use context and see that it didn't. But this is PXL, PXH. If you don't already understand this, I recommend watching TT Trades and look at his daily bias. And he explains it very well. So that's very helpful. Also, you can find Powell videos out there as well. But we can go over a couple more examples. Okay, so then we get this bullish close here, so above this candle. So now we're expecting the previous day high to be taken, this level right here, and it does, right? We come up here, close back down inside of this candle, so now we're expecting the previous day low to be taken, and it does, okay? Then, since we closed below it here, we're expecting this previous day low to be taken. Now it hasn't, and again, what do? We pumped up, retraced, pumped up. So we may not actually see this get taken, but that was the bias that we would have, okay? I'll do a couple more. Let's back it up. So here, there we go, okay. So here we are, we get this low put in. So since we closed inside of this candle, we're expecting this low to be taken. You can see this candle right here takes out the low, right? Then we close back, actually, no, so this one wouldn't have worked out, right? Closed below this low, so we would have been expecting here. But at the same time, you can see we just swept out this low, so a pump makes sense. So you can use some of your context, because this isn't going to be 100%, but it plays out very often, right? So then what do we see? Price comes up here, we get a close above the previous candle, so we're expecting this high to be taken, right? And it does, okay? Then we close above here, so we would have been expecting this high to be taken, but it didn't. Like, there's the time it doesn't play out, right? Then we close back inside here, so we're expecting the previous day low to be the draw on liquidity. Boom, it did. It closed below, so we were expecting this low to be taken, but it doesn't. We closed bullish. That's fine. Expected this high. Boom, didn't get taken. It's totally fine. When price is chopping in here, it gets a little bit more tricky, and you're going to be using other contexts. This is just how you frame your daily bias, right? So then, whatever, we close down here, expecting this low to be taken since we closed below this candle's open, and we sweep it out, close up here. This one was a little bit more tricky. Probably would have been bullish because we just swept out this low. But you guys see what I mean? If you guys need more in-depth on that, then go watch the TT Trades video that I'm referring to and understand that, or look up the Powell leaks or whatever it is. But look up PXL, PXH daily bias, okay? That's how you're going to understand the daily bias. And just because, like today, right, we were supposed to be bearish down to this low. Just because of that doesn't mean you have to keep a bearish bias the entire session. Again, we're building a narrative, so we're doing top-down analysis. You just have that in the back of your mind, right? That we're bearish based off PXL, PXH, but it doesn't mean we have to take shorts or have to take longs, right? Then number 2, we have mark PXL, PXH. Now up here, whenever we're talking about PXL, PXH, on the first one, we're talking about the daily bias, right? Number 2, right here, this marking the PXL, PXH means not only doing that, but it also means marking the previous day high, previous day low, previous week high, previous week low. And I will also include this indicator right here, the one I have labeled horchata, right? And it's going to mark these for you. So you can see I just turned on the indicator and now it's marked out the previous month high up here, previous week high, previous day EQ, previous day low, and previous week low, and previous month low, right? So it has all of these already built in. So you want to mark these out. They're all right here. Should come pre-built. It also has key opens you can use as well if you want to. But I mainly just use this for the PXL, previous day high, previous day low, previous week, previous whatever, right? So you want to mark those out. Okay, that's what you're doing here. You're marking out your key opens as well. Now, I like to do this on my own manually. So what I do is I go through here and you're going to mark out, for example, the daily open. Boom. You're going to label that daily open, right? Or whatever it is. You're going to do that. And which key opens are we marking out? Okay, it's going to be, we're going to cover this a little bit later, but I'll tell you right now, it's going to be the yearly open, the monthly open, the weekly open, the daily open. You can do New York open, 10 a.m. open, midnight open. I think those are most of them. So pretty much every key open you want to mark out. Now you're going to get to where you trade, specific ones. I pretty much mainly only actually use the midnight open and the 10 a.m. open as key entries, but I like to have the daily open, weekly open, monthly open on my chart to build context on where we're at in the day, week, month, whatever it is, right? So you can see how we're just building narrative, top-down analysis. Then we get into gaps liquidity, right? What does that mean? Okay. So let me turn off this indicator for a minute here. So we've marked out our levels. I'm just going to keep the chart clean though. Okay. So what liquidity might look like is if you think, I don't know, this is liquidity, right? You want to mark out draws that you think price would want to go to. So for example, right here we have relative equal highs. So this would be good liquidity to mark out, right? Because after we sweep this out, we might want to see a reaction off it or whatever it is, right? But that's how we start marking out our liquidity. And then what are gaps? You guys should know by now, but fair value gaps, you want to mark these out. Now I like to try to mark out the highest time frame. So starting on the daily, I don't really go up higher than that, but so here I'd mark out this daily gap. Boom. Daily, I would label it like this. I would go down to the 4 hour. Go down to the 4 hour, look for any gaps. I don't need to mark out any over here because this is all, super far in the past. I just look at the most recent price leg sort of thing. Or if we're coming up in a price action, then I would look over here, right? So I'd mark out this 4 hour gap and I would label it just like this. Boom. And this helps me keep my charts clean, helps me build my context, right? So there we go. Boom. Maybe I'm marking out this level of liquidity or whatever it is. Okay. But that's what it means whenever it says mark out gaps liquidity. Okay. Then coming down to number 3, we have find high time frame PD array, which could be a level like an order block, fair value gap, rejection zone, whatever it is. That one's kind of, the wording here is a little bit weird, but I'll show you what I mean. So let's say, we are bullish here. Okay. Where would price want to reverse from if we were bullish, right? Here on this time frame, it looks like it would be the 4 hour. Now why? Because also we have, OTE right here. So this would be a really good spot to look for an entry, okay? Maybe we had to go down even further on a lower time frame. And okay, well, there's nothing really in here. We do have a rejection block right here. We could use that, but really out of this leg, because we want to take entries and a discount, I think this 4 hour gap looks pretty good. So this is kind of what it means in this thing here. Find your high time frame PD array, or whatever you want to see price reject from. So I would think something like this would probably want to play out. And again, we're just building that high time frame narrative, right? So we went on the daily, we did our PXL, PXH, we've marked out our key opens, we've marked out previous week high, previous week low, all that sort of thing. So we know where we're at in relation to it. We know if we swept it, because whenever we take out those forms of liquidity, price can often reverse from it. So let's say we have, previous week high back here that it looks like we're targeting. So we're bullish. We have relative equal highs back here as well. I know we do, like up here, right? We have relative equal highs. Let's say this is like previous week high or something. And so we're bullish, right? Okay, so we've marked out our liquidity, we did PXL, PXH, whatever it says, you know, cool, but overall everything's pointing bullish. So now I've found OTE by pulling the Fibonacci from the low to the high up here, and I found this high time frame gap. It's the highest time frame gap we have other than this daily one down here, but this 4-hour one. I'm also seeing we have this 4-hour one right here, so price could want to come down to that one, which was already in line with what we had marked out, right? It just would be a little bit deeper of a discount. Sorry, 4-hour. So price could want to come down to that one as well. So basically either one of these two gaps, obviously this lower one would be a little bit better, but this high one as well. So that's what it means whenever it means find high time frame PD array, rejection block, whatever it is, because you could have also used this rejection block here if it was right. But for this example, I think it's better to do here because it's an OTE and it's a high time frame gap. But let's say we didn't have that gap, right? If we didn't have these two gaps here, then potentially, you know, we would use this rejection block instead because it's at least at a discount, etc. Now, number 4 is look for wick theory / rejection block, OTE, CE, right? So what does that mean? We already kind of covered that in the last one, but again, it's just pulling this fib here. That's the fib tool. So OTE is going to be this range here. And here are my fib settings if you want to see them. Screenshot that, you know, whatever. People always ask me for this. So here are the settings. But OTE is going to be the 628 level all the way down to the 786. That's optimal trade entry. So you want to be looking for your entries in OTE. Whenever it says wick theory, all that means is these high time frame wicks or long wicks, okay? Wick theory means these wicks are going to be super sensitive, okay? And as we've already alluded to in this video is, let's say this is our rejection block. The most sensitive part of the rejection block is the CE right there, this midpoint, okay? That's the most sensitive. Now, the whole entire wick is sensitive, which is why oftentimes we just, you know, set our entry at the very top of the rejection block. But the most sensitive part is the CE, so you can use those as entries as well. Okay, that's all wick theory means. So you want to be marking out your super high time frame rejection blocks so you know when we're trading into them because price can often reverse off of them. And I used to only trade the CEs of these high time frame wicks. That used to be all my entries, right? But I don't do that anymore. But I'm just saying that because these are the most important part of the wicks. So here for number 4, again, we're just marking out the optimal trade entry, the golden pocket, right? The OTE. We're looking at those rejection blocks. We're marking out the CEs. We're looking at all of that, okay? Now, moving on to number 5 is just stack confluences at a level. So we've already kind of done that by finding that 4-hour gap that was down here, which aligns with the 618. Yeah, you're just kind of stacking the levels. Now, this isn't really a good enough level that you could just limit. I would only really do that with high time frame rejection blocks if it's a stacked level, but you're stacking that level because you know you could look for a reversal around there. And whenever we do that, we would go in the lower time frames and try to find a rejection block at this level, which is exactly what number 6 is saying. So wait for an entry trigger. Now, again, these are Powell notes. I don't trade exactly like this, but it's a good outline of what I do. And so waiting for an entry trigger for me always means a rejection block, okay? But what you can also do is a CISD. Now, what is a CISD? I would recommend going to watch videos on that, but essentially, you see this high gets taken, boom. So the last like group of candles, which would be like right here, that would be the CISD, right? So you can see bullish candles, boom, on this move up. If we close below here, we would have a CISD, okay? For this one down here, right, we swept out this liquidity, or we could even do this liquidity here, boom. So it would be a CISD, would be whenever we closed above this candle here. We got a CISD, right? So you can literally enter on the closure above that, boom. Your stop here, whatever. I don't really do this, but I know a lot of people do. And you can see it's still a very valid trade right there. It's just we're not using a rejection block. I prefer to only use rejection blocks, but you can do the CISD as well, okay? Now, what would the rejection block look like, right? Here, there's not an entry on the hourly time frame on this rejection block, right? So we sweep out this, and we have to wait for this bullish candle to close for it to be a rejection block. I guess I forgot to say that at the beginning for what a bullish rejection block or bearish rejection block is. But one more thing I would add to that, whenever we were on this page, right? Another part is not against the draw on liquidity is we need to have a bullish candle close for it to be a bullish rejection block, and we need to have a bearish close for it to be a bearish rejection block. It doesn't have to be the exact candle that, is creating the rejection block. It just has to be a following candle. So like here, for this example, you can see this is a bearish candle, and it's not confirmed a bullish rejection block until we get this bullish candle close right here. So once that bullish candle closes, then this is the rejection block, right? And vice versa. Like if we look up here at this one, for example, right, we sweep out this liquidity up here. Since this bearish candle is the one that swept out liquidity, it's the highest candle, this would be our rejection block, and it was valid right whenever it closed. So your entry could have been this very next candle right here, because the very candle itself closed bearish. Now if this candle right here closed bullish, it wouldn't have been valid until this next candle closed bearish, right? So keep that in mind with rejection blocks. So, but that could have been your entry right here on a short on the hourly, right? This is a big, high time frame stop loss, but it's a valid trade. Get a liquidity sweep, and since we swept liquidity and we closed bearish, it's a good rejection block, right? I'm not saying it's perfect in terms of the bias and all that. I'm just saying for it to be a rejection block, it's pretty good. Now, what makes this even better, right? Here's a good example of engineered liquidity, right? We have this here. If we mark out this rejection block with the midpoint, boom. So right here we have engineered liquidity, which is just a wick that doesn't tap the CE, right? So untapped 1 hour CE right here with liquidity here. So now this should be a very sensitive level that we might see a good reaction from. That would be more something you would want to limit, right? But anyway, low time frame triggers, that's what we're talking about here, right? So CISD, you saw that whenever we marked those out, boom. A rejection block, that's what I use mainly. I'm not going to cover IFVGs, okay? IFVGs are super simple. I guess I'll cover them for just 1 second here. But let me see if I can even find one. All right. So right here, we swept out liquidity. Let me get this off the chart. We had this bullish fair value gap, and okay, so we have this. We closed below this gap here. Could have entered on this inverse right here. Stop loss like above here, boom, targeting the lows, right? It's another valid entry. I never ever use those. I know a lot of people do, but in my opinion, they do not give good risk to reward. So I would recommend staying away from those, but it's valid, okay? Or you just limit the level at like a wick CE if you have enough levels stacked, right? So that pretty much covers all of it. And then how do you manage your risk, okay? Here it says 5 to 10 point stop loss, but it doesn't have to be that, okay? A lot of times I trade M and Q, and I would take, like, let's say we have a 5-minute rejection block, okay? Let's say this is our rejection block here. It's not a rejection block until we get this bearish candle, right? Because this is just a wick and it's a bullish candle. We have to wait for the bearish candle to confirm it's a bearish rejection block, okay? But this would be probably a fine size for me to take. It's 12.5 points, so that's actually pretty solid, right? And you can see we get tagged in right here. So this would have been the trade. Bam. But in the morning session, you could have taken this rejection block, right? And it would be a little bit bigger. So it's about a 24 point stop loss, but that's totally fine, especially if you're trading the New York AM session, right? Which is pretty much the trade I took today, actually. But here you can see it's a 24 point stop loss, and it's bigger than what it says here, but that's totally fine. 24 or 25 points. I just wouldn't really go above 30 points. You could do it, you could, high time frame maybe, but on low time frames I would stick 25 points or below pretty much. And for risk, you don't want to be over risking on this because the win rate isn't super high, right? It's going to be like 30 to 60%. So you can lose like 4 out of 10 trades, 5, 6, 7, 10, not 10. Like anywhere from 4 to 8 trades in a row you could lose. So you need to be risking accordingly, where if you lose 6, 7, 8 trades, you're not blowing your account, right? So on a 25K, maybe you only risk like 125 to 150. And then on like a 50K, you risk like $200 to $300 per trade, right? Because it's a high risk to reward, so you can afford a lot more losses, and then those wins are going to make up all of those losses. So you can see on here we have some notes, right? Rejection block, it sweeps liquidity or it rejects a PD array. Engineered liquidity makes it better. You have a clear draw on liquidity. That is essential. You want to have a draw on liquidity. So what are good draws on liquidity? equal highs, equal lows, data highs, data lows, fair value gaps, pretty much any PDA, right? But it has to be in context, right, with other things. But equal highs, equal lows, very good. Candles with no wick, so like a doubles mark. Those are really good points of liquidity to target. And then to confirm these entries even more so, you want to be keeping an eye out for SMTs. Now, SMTs, I have an indicator as well, which you guys can use. It's not my indicator, it's by taking profits, but it's very good. It marks them out very well. It's not perfect, but you're going to have a very good idea when there's SMTs, and it does it in real time as well. But that pretty much covers the overall model, okay? Top down, that pretty much covers it. Now, I'm not going to go through every single thing in here because there's so much, it would take forever. But you guys can go through and click through these things yourself and learn more about them. You guys should understand each of these things already, but you can read a little bit more about them and pair them together even better. I'm just going to go through a couple that I think are very important, okay? So the AMD model, I think, is pretty important, right? What is that? It's just accumulation, manipulation, and then distribution. Now, you can go through here and read all this, but essentially what that means is price is going to accumulate, then it's going to manipulate one side of the range, and then it's going to distribute down or up, right? So you have your accumulation, manipulation, and then distribution. And what we want to be trading, clearly, is this distribution here. We don't want to be caught up in this accumulation. We don't want to be trading this manipulation. We want to get our rejection block entry and catch this entire distribution down, okay? And how do you spot this, right? Let's see if we can go on the chart right now and see if we can spot any. So literally, I didn't even have to go cherry pick anywhere. It's right here in front of us, okay? Accumulation, we manipulate these highs up here, even this one, get a beautiful SMT, and then we distribute lower down to these lows. So accumulation, manipulation, distribution. I could cover it more, but I don't think I need to. There's tons of videos out there on this, but accumulation, manipulation, distribution. We want to catch this distribution. And if you think about it like this, think about Asia session accumulating, right? There's less volume, it chops around. And then London session makes a move, that's our manipulation, and then you come into New York session and you get the distribution. Now, it's not going to happen like that every single day, but that's a good way to think about it as well. But you can also look on this on every single time frame, 1 minute, 15, 5, 1 hour, 4 hour, daily, any time frame. But if you're thinking about it in terms of sessions, Asia session, London session, New York session, okay? CISDs and order blocks, I don't really use these for my entries, okay? All I really use them for is a little bit of bias, right? So if I'm on the hourly time frame and I see price just came up and it front ran, you know, this, it didn't tap into the wick, but what it did do is it tapped into like this order block here, then I would make note of that, okay? Or sometimes, like for example, in this price range here, if we pull OTE, boom, you can see we have an order block right here. And why is this an order block? Because on the way up, we put one down candle in and continued higher. So once we close above it, it was an order block. So this order block here is an OTE, could be a very good level to look for some type of trade. But again, I'm not using these necessarily for my entries. It's just a little bit of context because sometimes price does things and you're like, why is it even doing that? It's not a rejection block, it's not a fair value gap. Sometimes it's order blocks. And then also the CISDs, you can use those as an entry model. Remember like this one we talked about, we swept liquidity. This thing here, boom, got closed above. It's also an order block, but you could just use that as your entry. But what Powell likes to do, what I like to do more so, is instead of using it for an entry, use it for a high time frame bias, right? So for this, we swept this up here. Once we close below this, we'll get a change in state of delivery. So then we know on the higher time frame, we're more bearish, right? Because we've had a high time frame change in state of delivery. So then we can look for a trade, you know, where maybe we pull OTE here and we look for, you know, a trade up here, right? Because we've had that change in state of delivery. If we get it right and then we retrace up, we're still bearish, etc. Okay, so you kind of want to use order blocks and CISDs as just your bias confluence, not necessarily part of your actual trade. Rejection blocks, you guys can read through that more, but we've already covered that really well. Fibonacci, I showed you guys my levels. Here are the key ones. You can read more about that as well. One that I haven't discussed too much in this video is opening gaps, okay? New week opening gaps, new day opening gaps, both are very, very, very good for draws on liquidity, right? You can see right here, it says free bias. Exactly. So whenever we have an unfilled new day or new week opening gap, we want to use those as targets, as draws on liquidity. Price often wants to fill those gaps. I'll show you guys right now exactly how to mark them. So here's a perfect recent example, okay? July 31st to the new to the new month, right? So it's Friday to a Monday, okay? So how would you mark out this gap? A lot of people just go here and they mark out the gap that they see right here, but that is entirely wrong. Okay, what you do, and you can write this down, okay? I would advise writing this down. You want to mark, okay, can't even see my text. You want to mark it out from the closing price of the previous day candle to the opening price of new day, right? So what does this exactly mean? Okay, so for this example, let's make it a little bit clearer. You want to zoom in on the 1 minute. Price closed right here. So you're marking the closing price, right? Closing price. You don't mark the top of the candle because it's a bearish candle and it closed right here. So you mark this low to the opening price of the new day. So you're not going to mark it to the high of this candle because that's where it closes. You're marking it to the opening price, right? So right here. So now this is our new week opening gap from the close to the open, okay? So what I like to do is put INWOG, put the date on here, which is August 2nd, so 2026, boom. And I'll just leave this on my chart. And what you can even do is extend these all the way right so they stay on your chart, because you want to have this on here until the gap is filled, because price always wants to come back down and fill these. Now, it doesn't always fill it fully, but the things you need to know about the new week opening gap is once we trade away from it, like we might trade away from it in Asia session, London session, we come down, maybe do something like this, right? It's not fill at all. We haven't tapped the midpoint. So whenever we come into New York session, I would be looking for a trade to take more of this liquidity. We want to come in and fill this gap. We want to fill in the new week opening gap. So I would be looking for something like that. So you want to use those as points of interest, PD arrays that we're drawing towards good draws on liquidity, and that's how you mark them out. Next, we have gap fills. Now, what are gap fills? Pretty much exactly what we just talked about with new week opening gaps, but instead, we're talking about like daily fair value gaps, 4-hour fair value gaps, etc. So again, just like with rejection blocks, the most sensitive point of a fair value gap is going to be the CE, the midpoint. And you can see that exactly play out right here in this very recent day on price action. On August 6th, today is August 12th, you can see on August 6th, we came down and we tapped the CE of this daily fair value gap and respected it absolutely perfectly. So that's not a gap fill, but it's partially gap fill. So you just need to understand that's part of it, right? The CE is very important. And here you can see how you'd pair this, right? So if you come down here, we have the swing low here where we reacted out of this 1 hour fair value gap, pull it to the swing high, and look where price retraced to OTE, right? Inside of this golden pocket, the 618, between the 618 and the 786, retraced right there. And what PD array was right here? This daily gap. What else do you see was right here? Well, let's get rid of some of this so we can see it even cleaner. But we also have, let me make it bigger, we have this order block. Boom, price respected it, maybe to the tick, right? I'm not going to measure that out, but pretty close, right? So that's kind of how I'd use those confluences. Next thing that's important is these market maker models. Okay, now you can have a market maker buy model, market maker sell model. Now, these things people get very confused about, but it's super simple. It's literally exactly what we just went over with AMD. Okay, so what it means is, it's like, the theory is market makers are like engineering liquidity. They're building this up so that, you know, it's easy to see where price wants to go. And it's literally accumulation, manipulation, and distribution, okay? So a market maker buy model would be something like this, right? So we're accumulating. And what do we have up here? We have a swing high. So the market maker buy model would be, and then you could say these are equal lows, right? We have this wick and this wick, relative equal lows, okay? Sure. We also have this one right here. So we're accumulating. Then this is the buy part of the buy curve of the market maker sell model. Okay, so basically, we have MM, okay, that's not even an M, market maker sell model. That's what this would be here. Okay, now why is that? Because we're accumulating here. Now this is the buy part. Every single market maker has two parts, right? It has a buy part, a buy curve, and a sell curve. Okay, so the sell curve is obviously right here, and the buy curve is right here. So on a market maker sell model, the buy curve is going to be first, and it's going to be a lot smaller, and then the sell part of the curve is going to be a lot bigger, and that's going to be last, okay? On a market maker buy model, it would just be inversed. So on an M market maker buy model, right? So we'd be accumulating, we would manipulate down, then we would distribute higher, okay? This here would be the buy part of the curve. This here would be the sell part, and you can see on a buy model, the sell part is first and it's shorter, and the buy part is second and it's longer, right? So it's literally just A and D. It's just a market maker sell model, market maker buy model. For this sell model, we manipulate it up into a PD array, which for this example is this liquidity right here. And then we go down to take out these relative equal lows, or just this swing low, whatever you want to call it. But people kind of get this super confused or whatever. It's just literally A and D, but with like confluence. So market maker buy model, market maker sell model. That's what that is. But you want to be looking at this, because if you see price accumulating, you're thinking, okay, are we going to manipulate higher to go lower, or are we going to manipulate lower to go higher, right? You want to be thinking about it. And so here, it was kind of easy to see, right? We had all of this low resistance liquidity right here. We had these kind of relative equal lows right here. We have a data low right here. And so whenever price is accumulating here, we're thinking, okay, we're probably going to manipulate the high and then sell off. And that's exactly what happens. And so you're not going to get it right every single time, but you want to be thinking about that whenever you see price start to accumulate. Or if you see, price manipulate up here and then we start selling off, then you can go back and look and say, okay, did we accumulate? Did we do that? You know what I mean? So you're not always going to see it beforehand, but try to see it after. Just try to start building these confluences and adding these things together. Now, risk management in psychology, I don't follow these right here necessarily. I kind of do. Like, I never de-risk 50%. I keep my risk the same. But you can follow this as well. This is what Powell recommends. And also, I don't really do 1 to 3. My minimum trade would be a 1 to 3, but pretty much mostly what I do is target a 1 to 5 or higher. Because for me, I like it better. It's just more ideal, and it plays out very often. Also, I would not recommend doing stop loss minimum, maximum, anything like that. You just want to keep it the size of the rejection block. And I'll show you really quick how you can shrink your stop losses as well for rejection blocks. So let's go back to this example here where we have, the sweep of this high, and we're using this rejection block, okay? So if you were to take this and you put your stop loss at the high of the rejection block, it's 12.5 points, which is 100% valid, and that's probably what I would do. But let's say you wanted to make it smaller. Let's just imagine this was on a different time frame and it was a much bigger wick, right? If you want to shrink it, what you can also do is you can find that rejection block CE, like you should always do. And pretty much you want to make sure your stop loss is always above the most discounted level, okay? So what we often do, this isn't a great example of this, but let's imagine we have Fibonacci and it was aligned here, okay? It's not, but we're just going to imagine it was, okay? So in this price range, let me move this over so it's easy to see. So right here, we're entering at the beginning of this rejection block for this example, okay? You want to make sure that your stop loss is always above the most discounted level. In this case, the most discounted level is this CE of the rejection block, okay? So you would need to have your stop loss at least above that, so right here. Now, if we pull the fib and it aligns like this, right, and the 786 is up here, now the most discounted level is the 786, so you'd want to have your stop loss at least above this, so it would need to be like here, right? It just depends on the trade, which one's going to be the most discounted level, because if price is all the way down here, clearly the most discounted level is the CE, so you would just want to have it, boom, here. Now, another thing that you can do, if you have a lot of confluences at this 786 level, like right now we have this, let's imagine there was something else here, I don't know what it would be, like previous day high or something, I don't know, something else is aligned with the CE, right? What you can do is just limit the CE instead of the start of the rejection block, and then put your stop loss at the high. This is going to be the most safest bet. Now why? Because we're entering at the most sensitive part of the rejection block, which again is the CE, and it's aligned with the 786, and then our stop loss is all the way at the high, because as we know, the entire rejection block is sensitive, but again, the most sensitive point is the CE, so we're entering at the most sensitive point, and then our invalidation is the wick high. So this is a very good way to do it. Now, I don't do this very often unless it's a very high time frame rejection block, so like a 1 hour, 4 hour daily. Then I will often limit the CE of those, okay? But the issue with this, you can already see, is for this example, you wouldn't have even got entered into this trade. Now, obviously the fib's not there, but let's just say we were doing the CE. You wouldn't have got entered because price tapped the start of the rejection block, didn't make it up here, and then we dumped, right? So that's what happens sometimes if you stick to the CE. For this example, again, 12.5 or whatever stop loss is totally fine, so you would have just probably done the full thing. But that's how you can make them smaller, is by putting it just above the most discounted level, and it has to be either the CE or the 786. Those are normally your most discounted levels. Or you limit the CE and put your stop at the high, right? Those are the two ways you can get a smaller stop loss. Now for me, how I trade my risk management, like as I mentioned, Powell's is this basically. But I don't really care about the size of the stop loss as long as it's under 30 points, right? But if I take a win, so 1 win equals done. Okay, you can't even read that. But made it a little bit clearer right here, okay? 1 win equals done. And this is per each account because 1 win for me is going to be, 1K or more most of the time. Sometimes like 6, 7, 800, depending on how much I'm risking, like on what size the account is. But normally it's going to be a big win because I'm trading high RR, right? So I can't even really take 2 wins. But if I take 1 win, I'm normally just done. 1 and done. Boom. Just like that. Per account. So if you have multiple accounts, you can hop on another account and keep trading. That's totally fine. But there's no reason to overtrade. You catch that nice reversal of the Judas swing, whatever it is. Boom. You're done. Right? If I take 1 loss, I don't de-risk. I keep the same risk. Dude, where's the equal sign? Take another trade. Equals another trade. If it's valid though, I don't just force another trade. I only do it if I find another good trade. Okay, most of the time I stick to this and I take 1 win or I take 1 loss. But sometimes I take 1 loss and then I take another trade and it's a win, right? And if you do that, so let's say you risk $200 minus 200, then you take 1 win, and our wins again are like 5R. So if you risk $200, you risk it again. Now 1 to 5R with $200 risk is a 1K win. So you're up $800. You see what I mean? So this high RR is very, very good. However, if I take that first loss, then I take another trade, and I end up with 2 losses, I am always going to be done. I never lose more than 2 times on a day because after I've seen, 2 losses, I'm obviously not right. Whatever happened, maybe I just got manipulated. It doesn't matter. I'm just done because you're going to hit your maximum loss limit or daily loss limit, and there's no reason to do that. You're clearly not reading price well, so just step off or switch to another account. That's valid. If you have multiple accounts, you take 2 losses on one account, boom, switch to another, that's fine. Just don't get in the habit of over trading, okay? Now, if I take like BE trades, just don't count as a trade for me basically. Like, I mean, they do, I journal them and all that, but like it doesn't factor it in. All I care about is if I win, I'm done. If I take 1 loss, I'll take another trade. Once I take 2 losses, I'm done. It's that simple. So if I get 1 loss, 1 BE, I can still take another trade. If I just get BE, 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 I can keep taking a trade until I've taken either 1 loss or 1 win. Sorry, 2 losses or 1 win, right? So, but often I just do these top things here. I'm either 1 win and I'm done, or I do 1 loss and done because normally I'm just trying to find the best trade and take that. So sometimes I'll take a loss, like today, for example, I took a loss and I didn't take any more trades because that was the only trade I wanted to take. After that, I was like, nah, I really don't even know where price wanted to go. That one trade was worth it for me. But after that, boom, I'm done. So I recommend you guys do something like that. You could de-risk 50% if you want, like Powell teaches over here. But I personally don't do that. This is my risk plan here. Something that's very important, I have to tell you guys, this is so, so important. Always risk about the same amount. Now you can vary this a little bit, like so, maybe one trade you're gonna risk, I don't know, $125. The next trade you want to risk $150. Cool. Or like one trade you risk $200, one trade you do $150, but you can't change it more than like $50, right? If you do that, the odds don't play out. Like you have to keep your risk the same for this strategy. Okay. Something else that's very important is always let your winners run. Okay, so if I'm in a trade and my draw on liquidity is 5R, I'm not taking profit until price hits 5R. Okay, I am not taking profit until price hits my target. That simple. If you take profit early, you are never going to be profitable with this strategy long term. That is very crucial. Another thing in terms of risk management is only go BE at a PD array or lick. So for lick, I mean liquidity. You only go break even once we've either tapped into, maybe it's a 1 minute gap, maybe it's a 1 minute inversion gap, maybe it's a rejection block, maybe it's a, just a swing low, whatever it is, you only go break even once we've tapped the PD array or liquidity, because too many times price is going to chop around your entry. I don't want to see you have one candle to the downside that's 18 points and you go break even, because price can come up and retap that, tap the order block or tap the rejection block, whatever it is, tap it again and go lower. You only go break even once there's a reason to go break even. So once we've tapped into something that could send us higher, or yeah, that's really it. Liquidity or PD array. Something that can send us higher or something that can send us lower. Whichever way you're trading, you want to wait for price to hit one of those before you go break even. Okay, this is a very important page. So take a screenshot of this and make sure you understand it. Okay, it's so important. This is like one of the keys to your success. Okay, all of this. So definitely lock in on that. Sorry. All right, next portion. So here we are with the checklist part of this little HTML thing, right? So you can come up here, boom, checklist. So super easy. What's your bias, right? And I don't really use this, I'm not gonna lie, but if you guys want a checklist, here it is. So this is the stuff you want to keep in mind. We've already went through this once whenever we did the full notes and we went over the Powell model here. It's essentially the same thing. It's just very clear. So step number 1, get your daily bias, mark out previous day high, previous day low, previous week high, all of those, right? Check the 4 hour, check the high time frame. I always go daily, 4 hour, 1 hour, 15, just like that. Boom. I'm looking for gaps, inversions, volume imbalances, high time frame rejection blocks, all those sorts of things. Then I'm marking out points of liquidity. So equal highs, equal lows, important swing high, important swing lows, all of those, right? Then I'm marking out, boom, new week opening gaps, new day opening gaps, any unfilled fair value gaps, all this stuff, right? Because new day opening gaps, new week opening gaps, free bias, boom, that's a target, right? Also be thinking about, what did the previous session do? If you see London swept one side and if you see London sweep one side, then you might see New York reverse, okay? Also, if you see Asia and London session just completely expanded 600 points overnight, probably skip out on New York, because we're just going to consolidate. Now, granted, maybe something happened like war, blah, 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 whatever the news is, and you just want to hop on that trend, that's okay. But if we expand a lot overnight, be careful trading the morning session, okay? But boom, that's how you acquire your daily bias. It's the high time frame, right? You're thinking about all those. Then you go down and mark your key levels. So you want to mark out all the key opens. I personally do the monthly, yearly, right? All the ones we covered. But the ones you need to be marking out for sure are going to be the daily open, midnight open, 10 a.m. open, okay? If we have a news day like we did today, right? Like today we had a news wick, and you can see right here at 7:30 my time is when CPI came out. So right away I marked out the low of the wick and I had marked out the high of the wick. You can clearly see we've already taken out the high. So this was the first draw on liquidity. After we took that out, my next draw was down here, and you can see prices has been slowly going down towards it ever since. So that's literally how you use it, because data highs, data lows are always going to be huge targets on liquidity. You're drawing liquidity very clearly. What you want to often see to trade this strategy, it's not even a strategy, but people trade this all the time, is you want to see one side get swept, and then you look to take profit at the other side, right? So you wait for one side to get swept, you enter and target the other side. Literally what I did today. Unfortunately, I got stopped out break even. I don't know why. Earlier I think I said I took a loss. I didn't. I just got one break even trade and didn't take any more. But yeah, so mark out your data highs, data lows. They're beautiful targets on liquidity. Then find your level, right? So now we're here, okay? What do you want to do? So you look for your high time frame order blocks, right? As I said, I don't really use them to trade. I use them as confluence, like that 1 hour that we talked about earlier. It was around OTE. We looked to our left. Boom, there's an order block sitting right there. Price tapped it literally almost perfectly, right? But use those, look for those, keep those in mind. You don't really need to mark them all out, but look at them, right? Sometimes if it's at a key level, like at 10 a.m. open, you have an order block right there with an FVG aligned, boom, that's a really good level, right? So you want to keep those in mind, and sometimes you can use those, but you're not always marking those out and things like that. I would put order blocks kind of just in the back of your mind, right? Then also look for rejection blocks, right? Look at a high time frame rejection block, so 1 hour, 4 hour, daily. Keep those in mind. Those are the ones I mark out and kind of leave on my chart, because price can go in there and start to respect them, and the CE is going to be very important. So the CE, the 1 hour, 4 hour, daily are very important. So you want to mark those out. These are just helping you get your bias, right? Look for engineered liquidity. Again, did we go almost to the CE of the 4 hour rejection block and didn't sweep it? So then that would be engineered liquidity, right? Think about if we're in the correct premium or discount, okay? What does this mean? You guys should know by now, but whenever you use a fib, also, really quick lesson on the fib, right? I see people mess this up all the time. If we are in an uptrend, okay? If we're in an uptrend, the way you pull the Fibonacci is always from low to high, okay? You could pull it from any swing low in here, right? Obviously, the whole leg would be from here, but if this down thing right here moved into a fair value gap or something, you could also pull it from here. It doesn't matter, whichever one you want. Obviously this is lower time frame, lower time frame, lower time frame, and this is the whole leg. But you pull it from the low to the high during an uptrend. Now, vice versa, if it was a downtrend, right, you would pull the Fibonacci tool from the high to the low down here, and you could pull it from any of these highs. If they manipulate into something, it would just be this low time frame, low time frame, low time frame, high time frame, full leg, right? That's how you pull them. So yeah. But whenever this thing here says is price in a premium or discount, okay? So if we are bearish, then up here above the 0.5, this would be in a premium, which is a good spot to look for shorts. You want to be shorting in premium markets, okay? If we are bullish, then we would have our fib the other way, right? And anything below this 50% level is in a discount, and we want to be longing from a discount, okay? So that's all it means whenever you see this here and it says is priced in the correct premium / discount. Now, you don't have to think about this too much if you're using the OTE / golden pocket. You already know because you're trying to long in the golden pocket or you're trying to short in the golden pocket, and that would be either in a premium or discount, so you're already doing that. Then this is probably the most important thing for all the trading is have a clear draw on liquidity. What do we use for those again? Equal highs, equal lows, new week opening gaps, new day opening gaps, data highs, data lows, unfilled fair value gaps, you know, a ton of different things. A devil's mark, which is just a candle with no wick above or below it. Those are all draws on liquidity. You need to have a draw and liquidity in mind whenever you enter a trade. It is essential. You have to be doing that, okay? So that's another thing. Then lastly, you want to look for SMTs, right? Again, grab that SMT indicator. It's all over. I have it linked in like my link tree thing. I might have it in the description of this video, but you can just look it up. It's called SMT Pro by Taking Profits, okay? Or you can do it manually as well. If you know how to do that. But basically, what do I want to say here? I guess, like you can see we have an SMT here. Now, this SMT is better than this SMT because this is like a higher time frame swing high. Whereas this is just kind of in this trend here, right? So it's not as important. So if we have an SMT here or here or here, it's going to be much better than an SMT here, right? So like this one and this one is a much better one than this, because this is, you have to swing high, but if you just look at the chart here, this swing high stands out way more than this one. So like this SMT is a lot better, or if we had an SMT here with this, it would be even better, right? You can use this as confluence, but I would mainly focus on the prominent ones like this. So that pretty much covers every single thing right here for the checklist, except for your entry trigger, right? I already went over CISD, I already went over rejection blocks and inverse feedback gaps, or you can limit the level, right? I would only really limit the level if you have a ton of stacked confluences at like a 1 hour CE rejection block or 4 hour or daily. So if you have, if the 705 on the fib lines perfectly with the 4 hour rejection block and it's in confluence with your bullish bias, that would be decent to limit with like a 20-point stop loss. Okay, that's the only time I would do that. Otherwise, I would look for one of these. Probably not an inverse fair value gap, but if you like those, do it. I would just look for like a rejection block on the 1 to 5 minute and take that at your level. Okay, and then lastly, use the fib OTE. So what is OTE? Again, just boom, right here. Optimal trade entry is a 786 to 618. You want to be looking for trades in here. So something smart to do, let's say we were looking for shorts in here, you would pull the Fibonacci from here to here, boom, or whatever the low is. Like obviously as price makes this low, you'd put it here, new low here, new low here, new low here, right? Then you would wait for price to retrace back up into OTE, which it did right here. So this is actually a pretty good trade, right? We pulled the fib from the high to the low, price retraced up into OTE, and we got our very nice rejection block right here. So that would be your entry short right there. Stop loss at the high right there. Target here. Boom. 1 to 7 risk to reward. And what are our confluences, right? We have, I mean, in theory, we had a bearish bias because we have these data lows down here. We just pulled OTE from the high to the low. We waited for price to retrace up into it. It hit our OTE level, so now we're looking for a trade. We get this bearish rejection block, so we enter on the rejection block, stop at the high, target the low. Bam. There's your trade. Just like that. That's all you have to do. So that covers all of that for the most part. Boom, execute and manage. That's literally it. You can use these risk things right here. I don't do that. Again, I cover what they were, so keep whichever one you want to do, just keep it consistent and make sure you do that, okay? But yeah, that's pretty much everything in the checklist. The only other things up here is the risk rules, which again, these are going to be powells. I gave you the risk rules, so if I was you, I would ignore this and use the one that I showed you on the chart and told you to screenshot. Also, you have quick reference here, so all this stuff's pretty important other than the risk rules. But you can see all this stuff here. But again, I'll drop all this for you guys to check out. Hopefully you guys got something from this video. If you've made it this far, please drop a comment and a like on this video. It should be super, super, super helpful. I just gave you the entire game plan for how I trade from A to Z. I don't think I left pretty much anything out, maybe a few tiny little caveats here or there, but overall, that is every single thing I do every single day going into the charts. Really quick, I wanted to show you guys my journal trading this strategy for July. Now, in this month, I was low-key getting kind of cooked, right? You can see it looks really bad, but this is a profitable month, okay? And on top of that, I missed a ton of beautiful trades. If you guys were watching my videos during that time, I missed so many good trades, okay? But let's do the calculations here. So if we look through here and we do the calculations, right? Add up all the losses. I had 14 RN losses. I had 21 RN wins. So I was still in profit over 7R. Now, I know that might not seem incredible or anything like that, but I got absolutely fried on that month. Okay, I literally was taking loss after loss after loss. I had a really bad streak in here these couple weeks. I was not trading well, but you can see it still played out. For the start of this month, if you guys have been watching my videos, you can see I've missed a ton of good trades. Like, I low-key, dude, I gotta lock in, right? But you can see 1, 2, 3, 4, 5, 6, 7, right? 7 losses, so minus 7R, but the wins, 5, 5. So we're up 10R, we lost 7, so we're up 3R on the month totally. And that is getting absolutely cooked. So if you're somebody that's unprofitable, all you have to do is this right here. And this isn't even amazing stats. This is like not good. Like most profitable traders are way more profitable than this. But me trading horribly the last 2-3 months, and I'm still in profit because of the strategy and the risk reward and following my rules. So clearly I did not show that to flex because there wasn't really much to flex. All that was to show that if you trade even poorly, all it takes is a couple of wins. And if you just stick to your strategy, if you stick to the risk management, if you stick to what I'm teaching you in this video, it is so high probability that you will be profitable. It's insane. So give it a try. Thank you for watching this video. Hopefully you guys have learned something. Please drop a comment. Please drop a like. Please subscribe. Do all those things. Check the description for all the stuff that I leave for you guys. But really watch this video a couple times, take notes, do all of that, lock in on this, and I promise you, you will see good results. And as you guys become better traders than me, you guys will become way more profitable, etc. Because you can see I had 2 bad months and I was still profitable. So now imagine what a good month would look like, where you have 5, 6, 7, 8, 10 winning days doing this. The opportunities are insane. So take this not lightly, take this to your heart, lock in, and get some good results. I'll catch you guys in the next one. Thank you so much for watching. I'm out. Peace.